Hey, Ken Smith, welcome back to another video. So if you're new to the channel, I have both financial videos and also fishing videos. I have a little over 300 fishing videos and about a half dozen so far financial videos where I cover a wide range of topics. Today, specifically, I'm going to talk about annuities and long-term care and how you might combine those. So let me put it to you this way. If you own an annuity or if you are considering buying an annuity, you need to watch this video. If you own long-term care or think you might want to own long-term care, you might want to watch this video. I'm going to share something with you that not many planners know about, and I think this will be worth your time. I'm going to try to keep this to be a pretty short video, which you guys who know my videos know short's not my middle name, but we'll get to that. So let's jump right in. So I've titled this video "Navigating the Annuity Tax Trap." And what you're going to find pretty early on here, and I'll just say it right out, I'm not a big fan of annuities. There are a few fact trails where we feel like annuities make sense for clients, but what we see all the time are people who have bought annuities and own annuities, were sold annuities by others. Actually, that's interesting. Most often we hear, well, I didn't buy it, I was sold it. And there's a problem with annuities, and the problem with annuities is the taxation on annuities. So first, let's take kind of a high-level overview of different types of annuities. Okay, so generally there's two types of annuities. There is a single premium deferred annuity, or it's a deferred annuity. Most of the time it's a single premium. How about that? It's called a single premium deferred annuity, also known as an SPDA. And then there are immediate annuities. Usually, again, a single premium immediate annuity, and that's called a SPIA. So a deferred annuity, also known as a single premium deferred annuity, basically annuities are issued by insurance companies, and you give your money to an insurance company in a deferred annuity, and they're going to grow that money for you over some period of time, which you determine. Now, there's really three kinds of deferred annuities. There is a fixed interest rate product, where you go to the market and they say, look, we promise to give you 3% for the next 3 years. It's a little bit better than CD rates usually, but usually there's a lockup period. They're not normally very long, a year, 3 years, 5 years. Some of them are longer. In fact, when rates were higher, you might lock into a longer one for a higher rate, but they're not terribly attractive right now with the interest rate environment. The second type of deferred annuity would be a variable annuity, and that would be a product that is tied to usually mutual fund lookalikes. They're called sub-accounts. So a mutual fund looking investment vehicle wrapped inside of the annuity. You pick out 1 or 3 or 5 of them, and however those funds, those underlying funds return, that's how you get your return from the annuity. Now, the trouble with those are, if you have negative years in the market, you can have negative years of return in the annuities. So again, not terribly popular with some, but not terribly popular. The most common and the most popular right now is an indexed annuity. And an indexed annuity does exactly what it sounds like. It invests in index, usually the S&P 500 index, sometime one of the Russell indexes, on occasion some international indexes. It has a cap and a floor. So usually the floor is 0%. So if the market's down 10%, you get 0. And normally the cap is 3, 4, 5%. So if the market's up 3%, you get 3. But if it's up 7, you only get the 5. So that's what an index product is. Now there's lots and lots and lots of bells and whistles built in index products. And I'm glad to talk to you about those if you have questions about them. But that's not our purpose for today's conversation. Then we have single premium deferred annuities, we have single premium immediate annuities, SPIAs. So in this case, you deposit your money with a life insurance company or an insurance company, I should be more specific, and they pay you some amount of money, usually monthly, over some period of time you determine up front. Now, that might be most often your lifetime or yours and your spouse's lifetime. It might be your lifetime with a guarantee to 10 years. So it's your lifetime, but if you die in the first 10 years, they promise to pay 10 years. It could be a 10-year payout. It could be a 20-year payout. There's all kinds of different payouts there. And again, glad to talk to you about those if you're curious. But that's just so you understand annuities a little bit for this conversation. Generally, those payouts are either fixed, so they say we're going to pay you $400 a month for the rest of your life. If you live beyond life expectancy, you win. If you live short of life expectancy, the insurance company wins. But what they know is if they get a large enough pool of people buying these, it'll average to life expectancy, and they'll make their profit margin based upon life expectancy. There are also annuities that have an inflation adjusted component to them. So this year they pay you $400, next year they pay you $408 a month, and the next year $420. So it's indexed up with inflation in some form or fashion. And then there's a variable, just like there is a variable in the single premium deferred annuities, and that payout would vary based upon how the underlying investments inside the policy vary. Most people who get into annuities are looking for fixed guarantees. They don't want to have that variable component built in there. So we don't see those very often, but we do see them on occasion with sort of more aggressive annuity investors. Now, that's the high level of types of annuities, but then we need to bifurcate them again as to where the money comes from. So the first one would be a qualified annuity. And a qualified annuity simply means you bought that annuity with money you have not paid taxes on yet. So typically it's going to be bought from 401k money, or more often from money in an individual retirement account, an IRA. So somebody buys annuity inside of their IRA. When you do that, any money flowing back out of that qualified annuity in the future, when you take income or a lump sum from that annuity, it's 100% taxable, and it comes out as ordinary income. So you pay taxes on it at your ordinary income tax rate, which, by the way, for the vast majority of us, that's the highest tax rate you're going to pay, as opposed to, say, capital gains tax rates that might be 15 or 20%. You might have a ordinary income tax rate in the mid to high 30s, and maybe higher than that in the future based upon what's happening with our economy and with our deficit this year. So I want to say something here that probably is a little bit controversial, but in our practice at least, we see typically a qualified annuity as something that a neophyte, somebody who's not terribly good or is new to being an advisor, does. Because what you're doing is you're taking a tax-deferred investment vehicle, an annuity, and you're putting it inside of a tax-deferred investment opportunity given to you by the IRS, being a qualified retirement plan. There's no reason to do that, right? You've already got the tax. So the advantage to annuities is tax deferral. You've already got that in the qualified plan. Why would you want to put one inside the other? I say in the text here, we find no or very, very few legitimate reasons to do this. I feel pretty comfortable saying no legitimate reasons to do this. I'm sure somebody out there has a fact trail that I've not seen where it made sense to do this. I've not seen it. The cost in an annuity on the very, very low end of a very, very large annuity is probably 40 or 50 basis points. So let's call it 0.5%. And when they start piling all the bells and whistles and the riders and the guaranteed incomes and the guaranteed returns, I've seen these be north of 3% of expenses. They're very expensive ways to invest. So why do I want to spend the money for the annuity wrapper when I already have the qualified plan wrapper giving me my tax deferral? And oh, by the way, it increases broker compensation. Annuities, typical commissions on annuities run anywhere from 4 to 7 or 8%, where a broker might charge you 1 or 1.5% to manage money outside of an annuity. So I'm not going to say more about that, but I don't like seeing annuities wrapped inside of qualified plans. If you buy an annuity with money you've already paid taxes on, so just your income, money from savings, however that money you inherited, that would be a non-qualified annuity. Now, when you start taking income from a non-qualified annuity, you're able to recover your basis with no taxes paid on it. So, for example, if you put $60,000 in an annuity and it grew to $100,000, the $60,000 that's your basis, you're allowed to pull out of the annuity without paying taxes on it because it's not gain. You will, however, pay the money coming out, the gain coming out will, however, be taxed as ordinary income, again, at your highest, generally for most of us, highest possible tax rate. We often hear these referred to as double or even triple tax vehicles. And what we mean by that is you pay taxes on the money up front, right, when you earned it. And then when you start pulling it out, you pay taxes on the gains. You pay taxes a second time. And if you happen to have a taxable estate from an estate tax standpoint, and some of this money stays in your estate, it's taxed a third time at an estate tax rate, which could be as high as 40%. So from a tax standpoint, there's some traps here, hence the name, the tax traps inside of an annuity. So let's talk a little bit about how that might look from a taxation of a lump sum, okay? So let's take an example here of a 55-year-old man who invested $59,500. I kind of backed into this number because I wanted a round number on the backside. Into an annuity for 10 years. He wanted to start pulling money at age 60, and he earned 6% a year. At 65, 59.5 at 6% over 10 years gross to right at $100,000. I rounded it just a little bit. If he then surrendered that $100,000 annuity at his 65th birthday or 66th birthday, he would owe ordinary income taxes on that $40,500 gain. If he were in a 35% tax bracket, he would owe $14,175 in taxes. So although he had a $100,000 annuity, he only had $85,000 in change in spendable dollars. And that reduces his return from that 6% gross all the way down to about a 4.15% net. If you go back to some of my prior videos, this is something I talk a lot about, is what is your net spendable return, not what is your gross return. Because gross return doesn't matter as compared to net spendable return. So that is a tax trap, right? It looks great, you earn 6%, it's tax deferred. But when it comes time to pull the money out, Uncle Sam has his hand stuck out, and it's stuck way out. You're going to pay taxes on that money coming out as ordinary income, and that can be up into the high 30% tax range. So 6% return, 4.15% spendable return. So how do you avoid that? Well, there's 4 ways, really 3, but if you're watching this video and you're already on annuity, one of them is not available to you. So the first one is don't buy an annuity. And don't get me wrong, I have sold annuities. Most of the time I sell annuities because somebody already has one and there's no way to get out of this tax trap. And we have done some annuities on individuals who've reached retirement age and they really want some portion of their retirement income that they simply can't outlive. That makes sense to me. I'm fine doing that. We'll peel off a little bit of their money and they know they got $200, $400, $1,100 a month guaranteed for the rest of their lives. But that's a pretty small factorial that I run across that person very often. So the other 3 ways to get out of the tax trap, if you will, is you can spread the money out over a number of years by flipping it into a single premium immediate annuity. And when you do that, you pay taxes in the year that you pull the money out. I'll show you exactly what that looks like in a second. Option 2, probably the least attractive option, is to just die with the money, never annuitize the money, and let your heirs worry about it. Probably not the best option. But as of 2007, there is another option available to us. So under the Pension Protection Act of 2006, which came into law in 07 or became effective in 07, they gave us a little caveat in there. And what that said was, we will allow you to take any old annuity that you got sitting around with money in it and make a tax-free exchange. It's called a 1035 exchange, 1035 tax-free exchange, into a qualified long-term care annuity. And if you then use the money in that annuity to pay for long-term care needs, whether it's at home or in a nursing home, you don't have to pay taxes on those gains. I'll show you what it looks like. But it's just a nifty little thing that was stuck in the Pension Protection Act that very, very few people, planners, CPAs, attorneys have ever heard of. And I'll explain why in just a second as well. So first let's talk about spreading the money out, right? So the IRS again says that if you spread that money out over a period of time, you pay the taxes as you withdraw that money. So let's go back to our, so by the way, and the way they determine how much of that money is taxable is something called an exclusion ratio. You kind of need to understand this, so let's go through it a little bit. So I ran an illustration a couple days ago I've got an engine, if you will, that will rank all the different payouts from about 50 different carriers. And I said, okay, I have a 65-year-old man who has $100,000, and we want to put it in a single premium immediate annuity today. And we want to have it pay out an income to him monthly for the rest of his life, no matter how long he lives. And the best payout yesterday, and by the way, these change daily, weekly, monthly according to interest rates, was $490.95 that he could take out of that. So $58.85 a year, which by the way is pretty simple math. It's a 5.8% payout. If he lives 5 years, he'd have made a terrible deal because he lived 5 years and he got paid $30,000 out of his $100,000 annuity. If he lives 40 years, he got a great deal because he gave the insurance company $100,000 and he got 230, whatever the math works out to that to be. He came out way ahead. Insurance companies know this. They know that on average we're going to live to life expectancy. So the way they calculate the exclusion ratio is the carrier would go to their annuity tables and their mortality tables, and they would say, okay, well, and I made this number up, but let's just assume their their mortality table said a 65-year-old man's going to live 22 years. So they'd say, okay, so we're going to pay him a benefit for 22 years, and then they would calculate the exclusion ratio like this. The insurance carrier creates a simple formula, so it's a numerator and a denominator divided. The numerator, now even though we're moving $100,000 into the single premium immediate annuity to turn the income on, we actually created that 100 earlier in our example by putting $59,500 into single premium deferred annuity. So that's our cost basis, so that's our numerator, $59,500. We divide that by our monthly payment times our life expectancy in months. 22 years at 12 months is 264 months. So 59.5 divided by 129,479 gives us an exclusion ratio of 49.95%. Now what does that mean? What that means is of the $490 a month that our policyholder is going to receive, 45.95% of that is excluded as taxation, as it's considered a return of his investment. It's return of basis is what that's known as. Then he would pay ordinary income taxes on the other 54%. So he'd pay ordinary income taxes on about $265 of his monthly income. And it stays exactly like that until his life expectancy. Now it doesn't matter how long he lives. But if he lives up to 22 years, that formula stays the same. If he lives beyond 22 years, they say he's recaptured all of his basis, and everything from there forward is gain, and he pays ordinary income taxes on the full $490 a month. So the mortality has nothing to do with how long he lives. It only has to do with the exclusion ratio. So that's one way that we don't avoid the taxes, but we mitigate the taxes by spreading them out, as opposed to taking the $100,000 lump sum at 65, having a $40,000+ gain, and paying a whole bunch of taxes on it. We spread it over the rest of that individual's life, or he and his spouse's lives, so that we can spread out that gain and therefore spread out the tax implications to them, both from this and also how it would impact their other income as well. The second way we already talked about, not the best way to do it. You can just simply die with the money in your estate and let your kids worry about it, or your heirs, whoever your heirs may be, or your spouse. And as I note, maybe a little bit later in this presentation, something along the lines of 90+% of all deferred annuities never get annuitized. People buy them and they just sit there and they save them for a rainy day, and that rainy day never comes. And they just die with this money in place, and their heirs pay the taxes on it. I would say, generally speaking, it's not worth dying to avoid paying taxes, but that's the option 2. Now, option 3 is a very little known strategy. In the last 12 or 13 years, I've probably shared this with at least 50 advisors, that be CPAs, attorneys, and money managers, and not one of them said, oh yeah, I'm familiar with this. And the reason they don't know about this is this was buried in pension legislation back in 2006. So it was passed in 2006, really became law in 2007. And what it basically says is You can take the money from any other type of a deferred annuity and through something called a 1035 tax-free exchange, move it into a tax qualified, some people call it a Pension Protection Act qualified long-term care annuity. And if you then use that money for long-term care needs, you never have to pay the taxes on the gain. I'll show you what that looks like in just a second. So this is something, well, let's get into it. Long-term care annuities are not good annuities for accumulating wealth, okay? They pay 0.5%, 1%, 1% return. As an annuity, they stink. As a way to avoid taxation, they're great. So generally speaking, people attain long-term care one of three ways. They buy it the traditional way that we all bought it, and we bought coverage on my mother, gosh, maybe 15 or 17 years ago. And the policy looked a lot like a disability policy. You'd buy it at age 50 or 55, and you would pay an age 50 or 55 premium until you needed to take benefit out of the policy. The problem, unlike disability insurance, if you buy a policy at age 50, it's guaranteed to stay the same premium through age 65 when you let go of that policy. Long-term care policies, most of them did not have those guarantees. And what carriers have discovered is they have much higher, now we're living longer, so they're experiencing much higher morbidity, much higher claims than they ever anticipated they were going to have. So they fixed it by coming back to us and demanding rate increases. My mother's John Hancock policy, probably 4 or 5 years ago, Hancock came back and increased her premium 77%, which is basically they doubled her premium. Northwestern Mutual just did the same thing in the last 2 or 3 years, and they basically increased their premium something along the same lines, or they said, or you can leave your premium where it is and we'll reduce the benefit in half. These policies, it's not gone well if you've owned one of these policies unless you were one of the very few who bought the early ones with guaranteed premiums. Now, there were recently policies in the market where you could pay for 1 or 3 or 5 years, and it was a guaranteed premium once it was paid up, not until, but once you paid that last premium payment, you were guaranteed not to make any more premium payments. I believe, now if you want to look into it, I'll look into it for you, but I believe all of those products are currently off the market being repriced. So they might be back on the market now, but I've not seen an announcement from a carrier recently that one's out there. The second way people get long-term care insurance is through these, which is what this is, an asset-based annuity. So you put a certain amount of money in an annuity, and then it levers up. I'll show you what that looks like to buy more long-term care, so that you have a long-term care policy with assets that you put inside the policy, inside the annuity. The last way you can do it, and I see this quite a bit, is there are a number of permanent life insurance policies that have long-term care riders attached to them, generally speaking, where you access some percent of the death benefit in the form of long-term care benefits. And it can be for home care or for nursing home care. So if you have a permanent life insurance policy, you might be able to turn that on the policy. More likely you'll have to get another policy reissued, which we do all the time with a long-term care rider on it. Or if you just need some life insurance, make sure that you look at a permanent policy with a long-term care rider attached to it. Okay, so let's circle back now to the one that actually probably looks the best out of those three, and that's using pre-existing assets in an annuity or otherwise to buy a tax-qualified Pension Protection Act, if you will, long-term care annuity. Now, I've already talked about the fact that these aren't great annuities from a wealth accumulation standpoint, but they do some pretty cool things. So this is a client. I've just changed the numbers a little bit so that my client will go, that was me. It was female, which is true. She had about $95,000 that she had put in an annuity that she probably was never going to need. She's got pretty substantial wealth. It had a cost basis of $48,000. So one of the options, and the son said, let's just cash it in. And I said, well, if we cash it in, we got to pay ordinary income taxes on $47,000. And they were like, yeah, we really don't want to add to our tax bill in a given year. So we started looking around, and what we realized was she was paying $6,000 a year for a long-term care policy, the traditional kind. By the way, when she bought it, she was paying $2,000 a year. She got a huge premium increase a couple of years ago. It's up to $6,000 a year, a little bit less than $6,000 a year. So what we looked at and what we eventually did was we transferred that $95,000 into a long-term care annuity. The carrier immediately adds a 2.5 multiplier to that cash amount if it's used for long-term care benefits. So she turned a $95,000 annuity into a $237,500 long-term care policy. Now, she can access that money for long-term care, and if she does, we'll never pay on that $48,000 or $47,000 of gain in there. If she never accesses it for long-term care, it works just like any other annuity. She can pull the money out later, or she can let it flow to her heirs, in this case her 2 kids, and they'll pay the taxes on it at that time. But when we looked at the numbers with her advisors, granted we were only getting 1% return from this annuity, but we were saving $6,000 a year in premium, which is like getting a 6% plus return on a $95,000 investment. So they said, wait a minute, we're going to get $950 a year in interest, 1%, and we're going to save $6,000. That's almost a $7,000 net gain to them. It's a plus 7% return. It was a no-brainer. And we see this quite a bit. Now, just know, she does have to go through underwriting to qualify for that long-term care benefit. A carrier is not going to take $100,000 and give you a $250,000 long-term care policy if you're going to go out on claim next week. So there is underwriting required here. It's not generally as tough as life insurance underwriting, but there's underwriting required. So the Pension Protection Act or the long-term care annuity does fall under the asset-based. Again, generally speaking, not a great annuity for accumulation purposes. It does, however, lever up the benefit for long-term care. If you don't use it for long-term care, you can still use it, pull the income later in life, either as a lump sum or monthly, or you can leave it to your heirs and let them deal with it. Who should consider this strategy? Anybody who has an annuity that they likely will not need during lifetime. That would be number one. And by the way, and so 90% statistics tell us never access these annuities. It's a rainy day fund and they never go there. And they never go there because it's the worst place to pull money from from a taxation standpoint. So most financial planners, if you bought one and you go to them, if they understand annuities, they're going to go, that's the last money we ever want to touch. We don't want to start triggering a bunch of taxes. Also know, most annuity carriers will let you bifurcate, split those annuities, and move part of it to a long-term care annuity. So let's say, for example, you had a $500,000 annuity. Well, there's no reason to transfer $500,000 to a long-term care annuity because you're never going to need $1.25 million in long-term care benefits. But you could peel off 100, move it over, have 100,000 leveraged to 250,000 long-term care benefit, and keep the rest of it either where it is or put it in whatever annuity best suits your style of investing and gives you the best return now versus when you bought it 3 or 5 or 10 years ago. Second, anybody who currently is paying separately for a long-term care policy might consider flipping to a asset-based style policy. It's not a great return, but you don't have to pay premium, and you never have to worry about them increasing the premium on you, which is an absolute concern in almost every type of long-term care policy in the market today. And then the last one would be, again, somebody who has assets, I'm going to say laying around, but you got assets that you know you're never going to spend. Why not peel off a little bit of it, put it in a long-term care annuity, and have the peace of mind that you got that long-term care sitting over there, and if you never use it, you get a little bit of gain out of it. But you get that multiplier. 100 becomes 250, 200 becomes 500. It's a way to have long-term care benefits and not be shelling money out of pocket on a monthly or quarterly or an annual basis for a policy that doesn't have guaranteed premiums. So if you have questions about any of this, annuities, long-term care insurance, life insurance, I'm glad to talk to you. I would love to talk to you. You can reach me on my direct dial number, 972-816-5367, or at my email address, ken@izelfg.com. Also note I've got several other financial videos up that talk about a bunch of other topics. Please browse that playlist. And if you're a fisherman, I got tons, over 300 fishing videos, and with a lot of views, over 100,000 views a month. So if you like goofy guys fishing, you might enjoy my fishing videos too. So thanks for tuning in. I hope to hear from you. Again, any questions related to insurance type issues, even if it's a health or a Medicare issue, I'll get you in contact. Medicaid supplements, I'll get you in contact with somebody. I don't do that, but I know really good people who do. So please reach out. Property and casualty insurance, I'll connect you with good people. I'm your insurance guy if you want me to be, and I'll get you directed to the right people on anything that I don't feel like I have the expertise to help you in. So thanks for tuning in, and I'll be back again here in the next few weeks with another video for you.